The recent decline in Japan's Nikkei 225 index has been driven by a confluence of domestic policy changes and broader global economic concerns. This downturn can be dissected into several core factors that provide a comprehensive understanding of the market's current behavior. Domestic economic challenges and policy shifts. End of negative interest rates. The Bank of Japan recently ended its 8-year period of negative interest rates, a significant policy shift aimed at stimulating economic growth and combating deflation. The BOJ raised short-term interest rates from negative 0.1% to a range of 0 to 0.1%. This was followed by an additional hike of 15 basis points to 0.25%, marking the second increase this year. The move away from negative interest rates, a tool used to encourage banks to lend more by penalizing them for holding excess reserves, signals a shift towards monetary tightening to address inflation and stabilize the economy. The rationale behind this policy change is multifaceted. The BOJ's decision was influenced by robust wage growth, which has outpaced inflation. For instance, average base wage rates increased by 3.7%, surpassing the inflation rate of 2.8%. This wage growth, driven by strong labor negotiations and government initiatives, has created a virtuous cycle between wages and prices, an essential condition for achieving the BOJ's 2% inflation target. Impact on markets. The increase in interest rates has several implications for the Japanese economy and its stock market. Higher interest rates generally lead to higher borrowing costs, which can reduce consumer spending and business investment. This cooling effect on the economy can lead to lower corporate earnings, thereby negatively impacting stock prices. Moreover, the end of negative interest rates and the modest rise in short-term rates have been interpreted by market participants as a signal that more rate hikes could follow, adding to investor uncertainty. Global economic influences. Another significant factor contributing to the Nikkei's decline is the strengthening of the Japanese yen. The interest rate hikes have narrowed the interest rate differential between Japan and other major economies, particularly the United States. This has resulted in an appreciation of the yen, which climbed more than 4% against the US dollar since mid-July. A stronger yen makes Japanese exports more expensive and less competitive in global markets, thereby reducing the profitability of Japanese companies that rely heavily on exports. This currency appreciation has compounded existing challenges for Japanese exporters. For instance, major exporters like car manufacturers and electronics companies face increased costs abroad, which can lead to lower revenue and reduced earnings. The yen's strength has disrupted the favorable conditions that had previously supported a robust stock market performance driven by strong corporate earnings and effective corporate governance reforms. Broader global market concerns. U.S. economic data and market reactions. The decline in the Nikkei is also part of a broader global market reaction to economic data from the United States. Weak economic indicators from the U.S., including rising jobless claims and disappointing manufacturing data, have stoked fears of a potential recession. This has led to a sell-off in global markets, including Japan, as investors brace for potential economic slowdowns and adjust their portfolios accordingly. Furthermore, concerns about the trajectory of U.S. monetary policy have added to market volatility. Despite signals that the U.S. Federal Reserve might consider rate cuts later this year, the immediate impact of high interest rates has been to slow economic growth and increase market uncertainty. This uncertainty has spilled over into global markets, including Japan, exacerbating the decline in the Nikkei. Global inflation and trade dynamics. Inflationary pressures worldwide have also played a role. Japan's economy, while showing signs of healthy inflation, is still vulnerable to global economic dynamics. Rising global inflation, driven by factors such as supply chain disruptions and increased demand post-COVID-19, has led to higher import costs for Japan. These higher costs can squeeze profit margins for Japanese companies, further impacting stock market performance. Additionally, the slow recovery of inbound tourism, particularly from China, has affected Japan's service sector. Tourism is a critical component of Japan's economy, and the slower-than-expected rebound has dampened economic recovery prospects. The muted economic recovery in China, a key source of tourists for Japan, has thus had a ripple effect on Japan's broader economic landscape. Future prospects and investor sentiment. Despite these challenges, there are reasons for cautious optimism regarding Japan's economic future. The structural reforms aimed at improving corporate governance and shareholder engagement are positive long-term developments. Additionally, the wage price spiral, where rising wages lead to increased consumer spending and higher prices, could support sustained economic growth if managed effectively. In conclusion, the decline in Japan's Nikkei 225 is the result of a complex interplay of domestic policy changes, global economic concerns, and market reactions to shifting interest rates and currency valuations. While the immediate outlook remains challenging, the potential for economic stabilization and growth through structural reforms and prudent monetary policy adjustments provides a pathway for recovery in the medium to long term. Investors will be closely watching how these dynamics unfold and impact both the Japanese economy and global markets.